For decades, the 401k has been, the absolute cornerstone of American retirement saving. We've all heard the advice, right? Max it out, get that company match, and just let that tax-deferred growth work its magic. But what if that trusted plan has a hidden flaw? A tax trap that so many successful savers just don't see coming until it's way too late.
A ticking time bomb. Wow. I mean, that's a pretty intense way to describe it, but honestly, it perfectly captures the hidden danger we're going to unpack today. Now, this isn't about scaring you. Not at all. It's about preparing you. Because the very account you've trusted to build your wealth could be hiding a huge tax liability, one that's just been growing quietly in the background all these years.
So first, let's be super clear. If you've been diligently saving in a 401k, you've been doing exactly what all the experts have recommended for years. You absolutely made a smart move, because the promise of the 401k is incredibly powerful.
And the advantages are obvious, right? You get an upfront tax break because your contributions lower your taxable income right now. Your money gets to grow without being taxed every single year. And of course, who can forget that free money from the employer match? It's been the winning formula for building a nest egg for a long, long time.
You watch that balance climb year after year, feeling more and more secure about your financial future. You followed all the rules, you played the long game, and it worked. But here's the twist. The rules of the game completely change the moment you stop saving money and start spending it.
And that's when you meet your silent partner, as some experts like to call it, Uncle Sam. See, the catch with tax-deferred accounts is that the tax bill isn't forgiven, it's just postponed. And now, that bill is coming due.
Okay, this slide right here gets to the absolute heart of the matter. With a tax-deferred account, like a traditional 401k, you get the tax break now. With the tax-free Roth, you pay the tax now. That one little distinction is the key to this entire tax trap. Because with that traditional 401k, every single dollar you eventually pull out is taxed as ordinary income.
So, let's imagine you've done an incredible job saving, and you're sitting on a $2 million 401k. I mean, that's a life-changing amount of money. It's a testament to decades of hard work and smart investing.
This is the question that catches so many people completely by surprise. That impressive number you see on your statement, that isn't what you actually get to spend. It's a gross figure. Before your silent partner, the IRS, comes to take their cut. Yeah, depending on your tax situation, your actual spendable cash could be 20, 30, maybe even 40% less. And just like that, your $2 million nest egg has the spending power of maybe $1.5 million. That's a huge difference. But believe it or not, the trap gets even more complicated.
You see, you don't always get to choose when you pay those taxes. After a certain age, the government actually steps in and forces your hand. This is what's called a required minimum distribution, or RMD for short. Basically, the IRS lets your money grow tax-deferred for decades, and now they want their tax revenue. Starting at age 73, you must start taking money out, whether you actually need it for your living expenses or not. And here's how the math starts to work against you. The amount you have to take out is based on your account balance and an IRS life expectancy factor. As you can see from this table, as you get older, that distribution period number gets smaller, and that means the percentage of your money you're forced to withdraw gets larger every single year.
This creates a really nasty snowball effect. These forced withdrawals can artificially inflate your income, and they can potentially push you into a higher tax bracket in retirement than you were in when you were working. That's the exact opposite of what most people plan for. Oh, and if you fail to take the full RMD, the penalty is a staggering 25% of the amount you should have taken out.
But all of this, it brings us to the most dangerous and, honestly, the least understood part of the 401k tax trap. It's a chain reaction, what some call a tax torpedo, that can cause your tax rate in retirement to just skyrocket.
So here's how it works. The amount of your Social Security benefit that is taxable depends on your other income. And what counts as other income? Well, you guessed it, every single dollar you withdraw from your 401k.
This slide here just illustrates the brutal math. When you take $1 out of your 401k, it doesn't just add $1 to your taxable income. No, that one little dollar can trigger a domino effect, causing 85 cents of your Social Security to also become taxable. So what's the result? You withdrew $1, but you're now paying tax on $1.85. It's wild.
So what does that mean for your actual tax rate? Well, get this. A retiree in what we think of as the 22% federal tax bracket could face an effective marginal tax rate of 40.7%. That's a higher tax rate than the wealthiest Americans pay on their top bracket, and it's hitting middle-income retirees.
This chart shows the trap in action. Just follow the line from left to right. Notice how the tax rate doesn't just climb steadily. It suddenly spikes. Bam! That's the torpedo hitting, as more Social Security benefits become taxable. Then, and this is the really weird part, once most of your benefits are already being taxed, the rate actually drops back down. It's this completely counterintuitive tax hump that can do some serious damage to your retirement income.
Okay, I know, that was a lot of bad news, but here's the really good news. This tax bomb is not inevitable. You can actually diffuse it. The key isn't just about how much you save, but where you save it.
The solution is what we call tax diversification. Think of your savings as being in 3 different buckets. The pre-tax bucket is your traditional 401k. The tax-free bucket is your Roth accounts. And then the taxable bucket holds stuff like a standard brokerage account. The whole goal in retirement is to have the flexibility to pull money from any of these 3 buckets.
Look at this comparison. It makes it so clear. On the left, you've got a retiree with all their money and a 401k. Every single dollar they take out gets taxed. But retiree B on the right, they can blend their withdrawals. They can take some money from the 401k, sure, but then they can supplement it with tax-free money from their Roth. This gives them total control over their taxable income, which allows them to stay under that torpedo's radar.
So the key strategies are all about building up those different tax buckets. Maybe considering Roth conversions during your low-income years to move money from the taxable bucket over to the tax-free one. And of course, planning your withdrawals strategically each year. It's not just about investing anymore. It's about tax-aware financial planning.
And really, that's the real challenge, isn't it? The skills that helped you build up your nest egg are totally different from the skills you're going to need to make it last. Understanding the tax implications of every dollar you withdraw is no longer optional. It's absolutely the key to a successful retirement.